If you're thinking about buying a house, worry no more about mortgage insurance, down payments, or credit score requirements. This video is going to give you the tools you need to determine if an FHA or conventional loan is right for you. Welcome back, and shout out to all the subscribers who have been helping to grow this channel. And if we haven't met, my name is Lili, and this is where I talk about my real estate investing journey and personal finance so that we can all achieve a little bit more financial freedom. Today we're going to talk about the differences between an FHA and a conventional loan, but more importantly, we're going to put real life numbers to the question and help you determine a solution for your situation. So stick around to the end of the video to find out how to get and use my deal calculator. Turn that like button blue, and if you're really real, subscribe and turn on notifications. Let's dive in. There are some basic differences between an FHA and a conventional loan, but at the core, an FHA loan is backed by the government, whereas a conventional loan is backed by private banks and credit unions. Because of that government backing, it makes the FHA loan easier to qualify for, meaning people who have less income, poor, or limited credit history will have an easier time getting an FHA loan than they will a conventional loan. The reason that banks are willing to give FHA loans to less qualified borrowers is because the government has basically said, look, if they don't pay it back, we're insuring this loan and we'll make sure that you, the bank, still get paid. So what are the terms that you can get with one of these FHA loans, and how do they differ from a conventional loan? There are a lot of fine print differences, but we're going to look at the six most important categories that are going to matter when you're buying a house. First up, the down payment and credit score requirements. With an FHA loan, if you have above a 580 credit score, you qualify to put just 3.5% down on a house. If you have between a 500 and a 579 credit score, then you have to put down 10%. With a conventional loan, on the other hand, if you have a 620 credit score, you can put down just 3%. Looking at this, it might seem right away that if you have a 620 and above, you should use conventional, and if you have less than a 620, then you should use FHA, but unfortunately, it's not that simple. Because conventional loans weren't designed to be favorable for low to mid credit score borrowers, there's a type of sliding scale involved with the lower your credit score is, the higher your interest rate is, which comes into play for these conventional loans. So in category 2, let's talk about those interest rates. With an FHA loan, your interest rate is less dependent on your credit score. It still does matter, but not as much as with a conventional loan, where right off the bat, the lower your credit score, the higher your interest rate, and vice versa. So yes, if you have a 620, with a conventional loan, your down payment could be just 3%, whereas with an FHA, it would be 3.5%. But with the FHA, your interest rate might be lower, and with the conventional loan, your interest rate might be higher. On the other hand, if you have a higher credit score, like in the mid to high 700s, then your interest rate on the conventional loan might be lower than the FHA. All of this, though, can be figured out if you get a pre-approval letter from your lender and just ask them, based on my personal situation, my income, my credit, all of that, what is going to be the best situation for me in terms of interest rate and down payment. So in order to see just how important interest rates are to your monthly payment, we're going to dive onto the computer and use my deal calculator to do a comparison. You can find a link to the download for this in the description below. It's completely free. All I ask that you like this video and subscribe to help support the channel. Alright, so this is what the deal calculator looks like. Only change the numbers in gray boxes, and we're going to do a scenario where we're looking at a $100,000 purchase. And what we want to come down here and do is we want to change this interest rate. So at a 4% interest rate, that's saying that our debt service, meaning the amount of the loan we're paying back, and the interest, not including the taxes and insurance, but just the debt service that's going to the bank, at a 4% interest rate with these terms, that would be a $460 a month debt service. Whereas if we were to just change this 1 percentage point higher to a 5%, we're now up to $518, right? So that's a big difference in your monthly payment, which is going to add up over years and years and years of extra money that you're going to be paying in interest if you don't get the lowest possible interest rate. So that's why it's so important. Category number 3 is mortgage insurance, which is another huge point of contention between FHA and conventional loans. With an FHA loan, you might see it called MIP, which stands for Mortgage Insurance Premium, and with a conventional loan, you might hear it called PMI, which stands for Private Mortgage Insurance. But either way, it's pretty much all the same thing. It's an extra part of your monthly payment that is required when you make a low down payment. Think about it this way. If you were going to loan somebody money, but you weren't sure that they were actually going to give it back to you, you might require a little bit of an extra fee up front just to kind of protect yourself. And this is basically how banks are looking at people that put low down payments. Someone who puts 3.5% down is considered more of a risk than someone who puts 20% down. Whether it's fair or not, that's what the bank is going to tell you when you go to purchase a house. With an FHA loan, you're going to have mortgage insurance no matter how much you put down, and talk to your lender because in some situations you'll have it for 11 years, in some situations you'll have it for the life of the loan. Depends on what lender you're using and your personal situation. But with a conventional loan, you'll only have to pay mortgage insurance if you put down less than 20%. In a moment, we're going to analyze the exact same property using one scenario, which is a low down payment with mortgage insurance, and a second scenario, which is a 20% down payment with no mortgage insurance, and we're going to see the actual difference and what that means for your monthly payment. I think you might be surprised at the result. And if you're watching this and you're a veteran and have access to a VA loan, you can put 0% down and have no mortgage insurance, which is pretty much the best of both worlds. All right, a couple more quick categories that we're going to blow through. Number 4 is the loan limit. With an FHA loan, in most areas you can borrow up to $331,000 for your house purchase, and with a conventional loan, that number goes up to $510,000 in most areas. So if the house you're trying to buy is above that FHA limit, then the conventional loan is your only option. Number 5 is your debt to income ratio, which is basically looking at the amount of debt that you have to pay out every month versus the amount of income that you have coming in. So if you have credit card debts and bills of $1,700 a month and you make $3,500 a month, that's a 48% debt to income ratio. Remember that it's easier to qualify for an FHA loan, and so their debt to income ratio limit is 50%, whereas with a conventional loan, it's 43%. All right, the last category before we dive into our real life example is the occupancy requirements of both of these loans. With an FHA loan, this is an owner-occupied loan, meaning you have to intend to live in the property for at least 1 year, whereas with a conventional loan, there's no occupancy requirement, meaning you don't have to live there, but if you're purchasing it exclusively to be an investment property, they may require that you put 20 to 25% down, and so it's not like you can buy it for 3% down and still use it as an investment property. All right, so we got that out the way. Let's dive back onto the computer and compare the exact same property using both types of loans. All right, so this is a property that I found in Las Vegas, Nevada. It's 3 bedrooms, 2 bathrooms. And I try not to choose example properties from states that are just super cheap because I know those of you watching live in very different areas. So some people might have a very expensive market that they're trying to purchase in, and some might have a very cheap market. So I try to pick something that's kind of middle ground. So regardless of how much properties cost in your area, run the numbers with the calculator and see if it works for you in your individual situation. All right, so this property is listed at $199,900, and I've done other videos going super in depth on how to use this calculator that I will link in the description below. But basically what I'm saying here is that in this first scenario, we're going to look to put a 3.5% down payment. We're not going to use down payment assistance, and we're going to pay 4% of the closing costs, which means to get into this property is going to cost us about $15,000. Up here, if you are using down payment assistance, you put the amount of the assistance in. So let's say I'm putting 3.5% of assistance, and that means my down payment or my initial investment is going to be about $8,000 because I'm getting that down payment paid for me. We're going to have a 4% interest rate with a 30-year loan. We're going to keep that constant throughout both of these scenarios because we want to compare the effects, not of interest rate this time, but instead we want to compare low down payment plus mortgage insurance versus higher down payment and no mortgage insurance. I put in some basic numbers for the home insurance and the property taxes, and down here I have $167 for mortgage insurance. Now the way that I got this is because mortgage insurance is usually 1% of your loan value. So we're borrowing $200,000, 1% of that is like $2,000, and then if we divide that up over 12 monthly payments, it's going to be about $167. You could do the math on the calculator or just on your phone, but that's kind of how I get to that number. So what this shows us is that with a low down payment plus $167 a month in mortgage insurance, we're looking at putting in $8,000 and paying out $1,300 per month. $8,000 in, $1,300 a month. Now let's do another scenario where we're looking at putting 20% down. What we're going to do is we're still going to get that 3.5% down payment assistance because if you're buying a house for the first time, you do still have the right to get that. They're not going to pay your full 20%, but they'll still give you 3.5%. Check out this video right here to learn how to get down payment assistance in your area. Same closing costs, same interest rates, same loan term. We're going to have the same property taxes and insurance, but this time there's no mortgage insurance. So here we're putting down $41,000 in and we're paying $1,000 a month. Now you tell me which scenario works best for you. Would you rather have $8,000 in and pay out $1,300 a month? Or would you rather have $41,000 in and pay out $1,000 a month? I'm not here to tell you what to do. I'm just here to kind of show you how to run the numbers to determine what's best for your scenario. For myself, I went with putting down 3.5% and using down payment assistance to get that 3.5% paid for me so that I had less money needed to actually get into the property. Yes, that meant my monthly payment was a couple $100s higher than it would have been otherwise, but I was okay with that because I'm house hacking a duplex, and I will put a tour of that duplex here so you can check it out if you want. Let me know in the comments if you like situation A with a low down payment plus mortgage insurance, or if you like situation B with a high down payment and no mortgage insurance. Please don't forget to turn the like button blue before you go. As always, I really appreciate you guys watching and supporting the channel. Until next time, thanks so much.